So the market has dipped rapidly, 5% after the Federal Reserve decided to hike rates by 3/4 of a percentage point and plans to continue doing so into the near future, aiming to bring down record levels of inflation since the early 1980s. Most importantly though, interpret how we can invest during these trying times of the market right after you hit the like button and subscribe down below. So the first major issue that we see right now is that inflation is going berserk. Essentially, inflation just means that the rate that goods and services increase in price over time equate to your dollars being worth less. So effectively, the Fed raises rates in order to bring down this inflation number if they're seeing the month over month and year after year prices growing too rapidly. So in terms of short-term price action in the markets, there will likely be more blood in the streets right until the end of 2022. But of course, long-term markets always shift for the better. Now the key driver for this downfall is that CPI data read at 8.3% in the recent announcement, whilst being forecasted to read at just 8.1%. And with past readings declining fast and the cost of petrol declining low in recent times, market experts predicted inflation would do the same, although instead they increased further from last month. So for most people out there, the cost of petrol has continued to rise, the cost of groceries is still at exuberant prices, and wages aren't going up at all. So the question lingering on everyone's mind right now is, what is the Fed doing? Well, they've come out and said that they'll continue these rate hikes until the job is done, meaning they want to continue raising rates until inflation is at a healthy balance. You see, the other problem is if they raise rates too fast, unemployment will increase, which is another factor you have to keep in mind. Because at the end of the day, the Fed wants a smooth economy at no cost to the people living within the country. And although exponential growth is needed for businesses to flourish, ensuring wages can match that speed without falling behind the mark is crucial. But currently they're trying to contract the market and bring this inflation back to what we call the 2% rule. This 2% rule is a goal set out by the Federal Reserve to ensure inflation remains steady over time and doesn't fluctuate too drastically. This also protects consumers by making sure their earnings aren't being eroded away by inflation, but also not being so low that people just hold on to their cash. And now that we know what the Fed is doing right now and all the intricacies in terms of inflation, let's look how we can stay level-headed as investors without worrying about all the fear in the market right now. And in order to understand this, I want to go over a quick topic that has been in the news recently called the lost decade. Now, the lost decade of investing, which is a term coined as a stagnation of a market that is slow, even negative in returns that lasts roughly 10 years. Now, I've heard a couple opinions on this, and the last 10 to 15 years, yes, have been really prosperous for the economy since the great financial crisis in 2008, especially for stocks, real estate, and crypto, of course. So a lot are asking, does that mean that the next 10 years must result in a slower economy? And my answer is that they may be right, they may be wrong, but I'm going to answer it like this instead. I don't know, you don't know, they don't know the future of the market. Similarly to ourselves, we don't know what we'll do in the next 10 years. Do you think when I was 9 years old, I pictured myself doing finance YouTube videos and working a warehouse job? No way. However, I do believe that continuing to invest into index funds and dabbling a little bit into individual stocks and crypto is just what works. Because I can make a reasonable prediction that those investments will go a lot further than putting your money in a bank account. History backs that even in the worst financial markets ever. I also learned that when there's blood on the streets, it is time to buy, and that is why I'm investing really heavily into Meta right now. So what do you as a consumer do in the midst of all this to help better your financial well-being? And my answer to that is, do the same. Don't forget to prepare at least a 3 to 6 month long emergency fund. Also don't forget the budget for all these price increases that may occur in the next 6 months. And of course, lastly, don't forget to keep investing in dollar cost averaging to index funds because over the long term, they'll always return well. And don't forget all these people on TV and in the media realistically have no idea what they're talking about in terms of predictions for like the next 6 months. Just make sure to be cautious of that and also just continue to stick to the simple investing principles. They always work out over the long term. Ask Warren Buffett. I hope you enjoyed this video guys. Don't forget to click my socials down below. And anyway guys, hang out. Another video done. Let's go. Alright, just a quick update. I know my hair isn't always perfect as it is in the video. But just in the video, and I've been looking at the news and the markets recently, and what's about to transpire in the next day for the market, and when it opens in 2 or so hours, Apple has apparently been hacked by some, I think, Russian company it is, and it's currently down 3.68%, went down as much as 4% in after hours. Alibaba 2.2%, Meta's down another percent. Everything's going to fall with Apple tomorrow morning. And there's no better time to buy them right now, guys. Even crypto. Crypto is down somewhere like 7%, I think it was. If I just look here. Ethereum 7%, Bitcoin 6.7%, XRP 10% after it was roaring in the last month. Oh, I'm just saying, guys, no bad time to buy them right now. Some really cheap deals, especially with ETFs tomorrow morning. The market, with Apple falling 4%, the market will drag at least 1.5%, you'd think, at least. Anyway, guys, end of the video. Heading out again.